Surveillance. I spoke with Carl Lentz of Credit Suisse. We discussed the five-year forward and the theme of rising future inflation expectations. I asked him how that plays into his interest rate call for 2011.
One of the things we looked at in our latest piece last week was this dichotomy where we had the market pricing for the Fed to start hiking next year, and then from 2 years out to 5 years out, the Eurodollars are pricing the fastest pace of tightening they've ever priced. And still, you get to a point 5 years from now, according to the market, where the Fed's at 5%, but we have an inflation problem with inflation from years 5 to 10 averaging about 3%, well above the Fed's target.
So, John, there's Carl Lentz of Credit Suisse looking out 5 years and then 5 years further from there. How do you use something like a 5-year and then 5-year forward break even?
Well, I mean, you can start out with a 10-year break-even inflation rate of around 220, and then you acknowledge with housing and core inflation really in a depression scenario for the next 1, 2, 3, 4 years, that you end up having a forward rate that's quite a bit higher than target. You know, Bernanke made some pretty forceful comments, I guess it was about 2 weeks ago. I guess that was the 60-minute interview. And what struck me is that he is gangbusters determined to get that inflation rate up to 2%. That was one of the messages. But then the other part of his message, and he came in actually stronger than I would have thought, on pointing out that it sounded like as soon as inflation got to 2.01, he would be tightening policy. Right. And that is, you know, putting the bond market on notice. You can't just blindly own long-term bonds thinking that the Fed funds will always be at zero.
Bring up too much information, which is a photograph of what John just explained to you folks. I love that. Johan, that's great organ there that you're playing, that little flutter thing. That's quite good. John, here's five-year break even. There's the crisis back in 08, 09. Up we go, and we've come up again. How far out the curve do we go with his present belief of disinflation versus the future belief of inflation? Is there a tipping point on the curve that can give us some information?
Well, we know that monetary policy operates with lags, and those lags are sometimes thought of it to be, you know, kind of in the 6 to 18-month range. You know, on the other hand, Fed policy has been very easy for some period of time. This is a crisis of historic proportions with debt deleveraging going on in balance sheets. So, you know, we are in a disinflationary world. We are in a low inflation world, but the Fed is fighting it tooth and nail with QE and buying assets, printing money, depreciating the dollar to the extent the euro doesn't depreciate faster than the dollar depreciates.
Every time you say disinflation or deflation, John Brynjolfsson, I get more emails from people saying, yeah, right, Tom, no inflation. Here, John, is a chart you know well, real corn, inflation-adjusted, price-adjusted corn set in today's prices. Let's cut to the chase. Forget about the early 80s. There's that spike in corn about 1996. There's that spike in corn about 2008, and we're revisiting that. John, I know ethanol's involved here, but we see it in wheat as well. What does grain inflation, or in general commodity inflation, signal to our viewers?
Well, I mean, inflation is about the general price level. You're always, I mean, any capitalist, any free market guy wants to see relative prices moving. That means prices of things that are scarce or dear move up, and prices of things that are overly abundant and excessively supplied move down. These days, things like housing and certain other services are being pressured down, and we're seeing you know, disinflation or outright deflation in as many products as we're seeing that kind of hyperinflation.
John, Margaret Brennan just had on Carol Masters' wonderful piece on gold and the belief of too high a gold price based on ETFs and that idea of a tangible asset. Are the commodity ETFs as messed up as gold? Is a corn ETF or a grain ETF, is messed up with it being a tangible asset as gold?
Well, you know, I'm not that concerned about ETFs distorting prices, because ultimately, to hedge up these ETFs, the vendors are selling spot futures, or the near-term futures. So they're buying the second futures and selling the near-term futures.
Right.
So they're continually rolling, and what that means is that the effect on spot prices, as far as I can tell, is non-existent. and there's even arguably the fact that they bring in hedging supply of products. So they enable hedgers to produce more corn, more natural gas, more crude oil. And so they're exactly doing what an economist would want the markets to do, which is they're encouraging capital to flow in to areas where capital is needed.
Right, let's switch to debt, John, and the nation's debt. Roger Lowenstein out with a great op-ed today. Folks, see it at Bloomberg.com. The debt pyramid scheme, now the norm in America. It's a lengthy piece. Let's stay on this a while, folks. The time to restore our public finances to the health is now, and if doing so delays the economy's return to full and robust growth, then let the recovery come more slowly and let it be built around sound financing. John, do you agree with that? Do we need to slow down GDP to fix the finances, or do we goose GDP and then worry about the fiscal deficit?
Well, this is the biggest debate that's going on in the globe right now, and Europe is, by and large, picking the austerity path. We're seeing that in England, where you just have budget cuts that are extraordinary. You're seeing a little bit of that in New Jersey with Christie on TV last night. But by and large, the U.S. is trying to grow its way through this fiscal crisis. There is a debate out there. I think the current package that the Republicans and Obama agreed on probably has it right, and the focus on fiscal austerity or spending cuts going forward, you know, is something that 2012 needs to focus on.
Bring up elegant chart, please, here, folks. This is a great chart. Thank you, David Malpass, for this at Encima Global. It's outlays, it's receipts, and you can see that 4-year gap now. Trillion. John, you mentioned Governor Christie on 60 Minutes last night. Are you brave enough to buy California paper? I mean, you're out there surfing every day. Do you buy California paper here?
You know, I just had this discussion.
Stop a minute. Look at the tan on him. Are you kidding me? Life is tough out in out in California.
It was freezing out here. It got down to 50 over the weekend.
It's terrible. Would you buy California paper here, John?
You know, I do own quite a bit of what they call escrowed munis. I own some FHA guaranteed munis, and sadly, I think I own a little bit of some California munis that have some kind of insurance wrap on them. After seeing Meredith Whitney on 60 Minutes last night, I'm certainly thinking about selling those.
Well, that's good. Meredith Whitney with a big influence there. John, one final question. Where's the Dow a year from now? Equity markets in general?
You know, I think the U.S. stock market does have room to rally, you know, 5–10% maybe towards that, 12,000, 13,000 range. The U.S. market has relatively attractive PEs. Bond yields are relatively low. While I don't really believe the earnings, they're not ridiculous at this point.
John, let's leave it there. Thank you so much, and greatly appreciate that perspective here. We're going to come up. We're going to talk about the equity markets later in the half hour. Coming up, though, Dawn Kopecky of Bloomberg News, and we will look at the one.